including the low-income households and MSMEs in the formal financial sector. We recognize that MSMEs face persistent credit constraints, which are compounded by delayed payments from large buyers and limited access to formal debt markets. Towards that end, I believe that we must best utilize our DPI and technology-driven solutions, such as cash flow-based and invoice financing, which can enhance liquidity for this sector. While the public sector would continue to focus on infrastructure development, we hope that the pass-through of the recent GST reforms will ignite the much-needed animal spirits in the financial sector. These emerging trends that I have highlighted call into question the usual known ways of doing business and challenge all of our stakeholders to come up with the most optimal and effective solutions and outcomes. And far from being worried about these trends, take the bull by its horn, work collectively, analyze them deeply, and see how to channelize these so that financial flows become smoother within the domestic economy to all segments that require finance to help us grow towards in pursuit of the Viksit Bharat of 2047. Thank you so much.
I think that was a phenomenal speech, if I may say, not only with substance, but really recognizing, not just or acknowledging what the private sector have been talking about and really taking it as in the policy framing. That recognition was very, very critical and important. And coming from you, it is indeed a delight that as you frame and the economic policies for the country. Also, I mean, phenomenal work already done by the government, which you talked about. But as you mentioned about it, you also talked about what more could be done. And that was very, very reassuring, which I'm sure there will be a lot in terms of partnering between the financial sector, the industry, and the government in seeing to it how we take the many, many important points that you raised further. With that, it's a pleasure and a delight to now turn to Dr. V Anantha Nageswaran, the Chief Economic Advisor of our country, to request him to deliver his address, please.
Thank you, CB, and a very good morning to my colleague, Ms. Anuradha Thakur, friends, ladies and gentlemen. It's a privilege to join all of you here at the opening plenary of the CII Financing Summit 2025. Let me begin by thanking CII for convening this gathering of country's most influential voices across banking, insurance, pensions, NBFCs, and housing finance companies, private capitals, fintech, infrastructure, and the real economy. I would also like to acknowledge the leadership of the Department of Financial Services, which has partnered with CII to shape an ambitious agenda for this summit. This summit is especially meaningful for me because I had the privilege of initiating it with CII last year. It stands as a testament to what is possible when policy, markets, and institutions come together, not just to exchange ideas, but to forge implementation partnerships that truly matter. I listened with great interest to the remarks made by CB. The suggestions he made were thoughtful and timely, many of them consistent with the work already underway within the government, which my colleague highlighted very amply. I particularly welcome the emphasis on scale innovation and institution building, three pillars that will define India's next financial chapter. Over the past year, CII's engagement on issues such as sustainable finance, digital trust, and infrastructure development has created real and valuable momentum. Today, As we reflect on financing future growth, we do so at a moment when the global environment has shifted more dramatically than many of us expected. Major geopolitical events over the past year, too many to list, carry profound implications for India's present and future. The world may have irreversibly changed, compelling us to adopt a wider, more strategic lens. Globalization, already fraying at the edges, is being reshaped by geopolitical realignments, trade fragmentation, the race for technological dominance, and financial retrenchment. Capital flows, traditionally driven by market signals and macro fundamentals, are now increasingly influenced by political alignments and strategic considerations. For India, this presents a familiar paradox. On the one hand, we remain among the world's fastest growing major economies with robust macroeconomic fundamentals. On the other, foreign investors continue to demand a higher country risk premium from India compared to several of our developing peers. My apologies. As per Damodaran's January 2025 article, estimates place India's country risk premium at 2.93%, which is higher than Indonesia, the Philippines, and Mexico by 39 basis points, and higher than China by nearly 200 basis points. This reality forces us to confront a simple truth. For decades, global capital has complemented our domestic savings, supporting infrastructure, technology adoption, financial deepening, and private sector expansion. But if capital flows continue to gravitate along geopolitical fault lines, external financing alone will be insufficient to meet the scale of our development ambitions. If India is to fulfill its aspirations, the primary drivers of financing must increasingly come from within. External capital can and should supplement our efforts, but the strategic burden must rest on domestic institutions. Uncertainty can only be blunted by institutional strength at home, and our financial sector must evolve into our most reliable source of stability. Last year, I noted that fiscal, financial, and monetary decisions are inherently local. That is even more true today. At the same time, we cannot ignore the risks emerging in advanced economies. Financialization has deepened, often in ways detached from underlying economic realities. Rising asset prices alongside slowing productivity and weak employment growth, widening trade deficits, and persistent fiscal imbalances in the developed world are important fault lines. The global economic outlook of the International Monetary Fund, brought out last month, explicitly warns a potential bust of the AI boom could rival the dot-com crash in severity. Unwinding of these positions could entail a slow economic recovery hampered by capital misallocation, unquote. This should caution us against complacency. India cannot allow its financial sector to drift away from the real economy, nor can we afford vulnerabilities created elsewhere to spill over into our markets. Stability, resilience, and alignment with national priorities must anchor our financial system. Let me therefore outline our goals and what they require from India's financial institutions. For India to sustain its growth trajectory on its journey to becoming a developed economy, domestic drivers must be strengthened across at least 4 high-priority areas. 1. Industrial upgrading. Moving from assembly to higher value-added production. That means moving beyond import substitution to building strategic resilience, ensuring continuity and security of critical supply chains under geopolitical stress. 2. Harnessing the demographic dividend. Our population is young today, but this window of advantage is finite. Its full utilization will determine whether we rise to our potential or fall short. 3. Achieving near energy self-sufficiency, ensuring that energy is clean, affordable, and reliable. Nuclear energy will have to play a central role, but the state cannot deliver this alone. The private sector participation is indispensable. 4. Deepening innovation capacity. India's R&D expenditure remains predominantly government funded. The private sector contributes only 1/3 of the gross research and development expenditure in India, compared to 70% in the United States, 57% in the European Union, and 79% in China. This must change. To meet these 4 objectives, the financial sector carries a far greater responsibility than that borne by other sectors. This is not a task that reforms alone can deliver. It requires a shift in mindset. Business as usual financing will not suffice in an era defined by uncertainty and technological discontinuities. How we lend, how we assess risk, and how capital markets allocate value all must evolve. The banking system today is healthier than it has been at any point in recent memory. Non-performing assets have declined sharply. Provisioning has strengthened. Capital adequacy is robust, and liquidity remains comfortable. Regulatory efforts to enhance ease of doing business will further improve the operating environment. But balance sheet health is only the beginning. The next leap requires a move from balance sheet preservation to balance sheet deployment. Past credit cycles have left scars, leading to a preference for short-term lending, collateral-heavy underwriting, and a tilt towards incumbents over innovators. If India is to build productive capacity for the next decade and beyond, our financial institutions must provide patient, long-term capital that supports enterprises across their full growth trajectory, not just their immediate credit needs. That requires ambition, an ambition that reflects the scale of the nation's aspirations. Banks and financial institutions must become bolder, technologically sharper, and more willing to take calculated risks. India and the world stand at large inflection points. This is not an era for timidity. Innovation in financial products must accelerate in the following areas: blended finance for climate, robust urban infrastructure financing models, digital-first insurance, pension products suited to India's burgeoning gig workforce, and credit models rooted in alternative data. The transition to a high productivity economy demands that institution takes risks at the frontier, not merely where pathways already exist. India must also prepare for discontinuities such as the potential effects of the US Genius Act, which may become effective in 2026, and the rapid evolution of fintech. As my good friend and RBI Deputy Governor Ravi Shankar noted on the 7th of this month in this city, in the SBI conclave, banks face existential challenges that require deep introspection. Acquiring fintech companies may appear quick and convenient, but that does not address the deeper question of what banking fundamentally stands for. Tokenization and the disintermediation it brings are inevitable. Banking leadership must view discontinuous change not as a threat, but as an opportunity to reinvent and rediscover the true purpose of financial intermediation. Our capital markets too must evolve, not just in scale, but in purpose. India's equity markets have grown impressively, but initial public offerings have increasingly become exit vehicles for early investors rather than mechanisms for raising long-term capital. This undermines the spirit of public markets. India cannot rely predominantly on bank credit for long horizon financing. A deep and reliable bond market is a strategic necessity, particularly for financing long-term national objectives. Insurance and pension funds, whose horizons naturally align with long-term investments, must play a larger role. However, the edifice of the bond market will be built on the foundations of trust and transparency, to which corporate leadership must commit on a durable and demonstrable basis. Globally, moral and visionary leadership in the corporate sector has become rarer, and what is rare is precious. Leaders in the Indian financial sector have a historic opportunity to lead in this regard. Financialization, which means the interest of finance run ahead of the real economy, may mean short-term gains, but undermines long-term economic competitiveness and vitality. The structural changes underway and still unfolding in the global economy pose challenges which can be turned into opportunities with long horizon thinking and execution. Here, I would welcome finance running ahead of the real economy and setting an example with long horizon thinking. Let me conclude with a few final thoughts. As we look ahead, we must recognize that none of the priorities I described will be achieved quickly or through momentum alone. Our financial system is stronger today than it has been in years, but we must not mistake strength for readiness. The demands the coming decade will place on our institutions are unlikely to be anything we have already encountered. India has reached a point where aspirations alone are no longer enough. Those of us entrusted with shaping the system must remain clear-eyed, disciplined, and also ambitious. We must avoid the temptation to celebrate prematurely when the road ahead is long and, as the poet reminds us, where there are miles to go before we sleep. Equally, we must guard against celebrating the wrong milestones, such as market capitalization ratios or the volumes of derivatives traded. These are not measures of financial sophistication. They only risk diverting domestic savings away from productive investment. In conclusion, I look forward to the deliberations at this summit and hope that the financial sector recognizes and embraces the historic opportunity before it. Thank you very much.
Two phenomenal thought leaders speaking, covering huge gamut of areas, and both just not thinkers, phenomenal thinkers, but great doers too. And of course, the way they spoke, I must say, the appreciation and understanding of the real sector problems and how the financial world has responded and has done so much. And it's been very refreshing the last few months, especially in the last couple of years. There have been some phenomenal changes that we have seen. The expectations from also the private sector is extremely strong. And probably, I don't know which way is more in terms of what the private sector recommends more to the government, or the government now starts recommending to the private sector to get going, given the phenomenal policy reforms and the facilitations that have been done. I have been given the opportunity to also pose a few questions on behalf of the House to our two guests of honors present here. I'll start with the DEA Secretary, and about one area, you have been leading, of course, this and your department, the strengthening of the financial market infrastructure, including you talked about better disclosure standards, risk management, as well as deepening the government securities market. So what do you see as the next steps in terms of a broader vision for making India's financial market, especially globally more competitive and more resilient?
Thank you, CB. I think you mentioned, and so did I, as well as Anand, the various steps which are already taken. And moving forward, I would say, like I mentioned, we need to take more measures to deepen the corporate bond market, the municipal bond markets, and even the equity markets in terms of depth, not just liquidity. For this, I think more steps need to be taken to simplify processes, progressively digitize processes for FPIs, streamline KYC for NRIs, and also harmonize regulations across regulators so as to reduce compliance friction for investors. I think that's an important area that we are working on. And like Anand mentioned, support innovation, innovators as against incumbents. I like that phrase. That is something that I would request financial sector to respond to, but we will do what it takes to enable that. I would rest at that. And basically, I think the role of government is to create a more predictable, accountable, and transparent environment and ecosystem. So steps towards that.
Thank you. Thank you very much for that. And I'd like to turn to the CA because I don't want to sort of sound as if I'm interpreting your speech in a manner, but do you see the Indian private sector not really being able to respond and not being able to participate or keep pace now with the type of need that is there for India to really keep on climbing the spot and take advantage of the economy? Is there besides the animal spirit, are other things lacking in spite of creating the financial architecture that both of you spoke about?
Thanks, CB. I don't think I'm going to accuse you of trying to fire from my shoulders. But yes, I think you did interpret my remarks quite well. And I think the burden of my song is that what is transpiring in the world today is a tremendous opportunity, provided we can see it that way. I think what I perceive in my various interactions, both inside and outside the country, is that our private sector has found enough reasons in general to sort of remain cautious and risk averse, but not take investment and other decisions that would turn these strategic constraints today we face into opportunities. To some extent, in fact, that we have succeeded in developing a very sophisticated and robust capital market, imbibing some of the best practices from the developed world, although they may have abandoned them, may also have contributed in part to more of short-run earnings management optics, because they are linked to executive compensation and market capitalization increases, which also boost the value of stocks and options vested, etc. I think all of this may have played a part in inhibiting long-term financing or using ample cash reserves in deploying them into financial investments rather than making real-world investments. So there is a need for ambition. There is a need for risk-taking and long-term investing. Otherwise, India will, as it has discovered in the course of this year, will find itself falling short with respect to strategic resilience, let alone building strategic indispensability in a world where we want to be one of the largest players in the coming years.
Fantastic. Thank you. Thank you very much for that very, very candid sort of response. One of the things that we also touched upon when we were talking about the financial architecture, financial institution, is in the opening session was about the gift city. And I'll turn to the, again, Secretary to talk a little bit more on some critical reforms or enablers that you see that still can be brought in to make such a success of the gift city, which has already been there, to be much more meaningful in terms of global capital flows and making it really internationally much more important, center stage, if I can say.
Sibi, so the gift city, in one of the recent interactions with a bunch of investors, very interestingly, they placed it before us that they view India as not only having positioned gift city IFSCA as a very ambitious financial hub, but they also urged us to use it as a sandbox for the rest of India. So using that example or using that metaphor that they placed before us, I think our approach to gift city is to try and push for continued alignment with international market practices. So some of the key areas which the IFSCA regulator is working on in a consultation with us is more facilitative fund management, deeper use of digital technologies, enhanced regulatory clarity, and some new spaces such as maybe a new arbitration center, etc., which strictly speaking would not fall in financial services, but they would, because that is key, like you talked about dispute resolution. So some new sectors also need to be thought about and brought in so that the entire ecosystem can keep growing.
Thank you. Thank you very much. I think we are running out of time, but I'll close once again with a question, so to say, or request for a comment from the Chief Economic Advisor, that he's just now come back from a country which is giving us a lot of uncertainty. And in this uncertain world, and given the type of positioning that we are really talking about today on the financial sector and reforms, as well as moving ahead in taking the economy. So how do we navigate during these uncertain times as we close this session, and what you really expect us to discuss over today and tomorrow in the aspect of that uncertainty which is emerging in the global world?
Thank you, CB. I think that's a good but slightly open-ended question. I think what I gathered in my 3 days spent on the West Coast last week is that, notwithstanding the current official level uncertainty and sort of logjam we find ourselves in, the strategic value of economic relationship in multiple dimensions with India is very well appreciated, and it was reiterated by different interlocutors that I came across in those 3 days. And therefore, it's important that we continue to sort of deepen those engagements, as we have been doing in other areas such as defense or information sharing, or in the critical minerals alliances, etc., or in pharmaceuticals and medical technologies. So in many scientific and financial and technological collaboration and security-related collaborations, I think we need to deepen them. And at the end of the day, in fact, one of the participants in the India Policy Conference said, the world is not deglobalizing, but reglobalizing with different weights on different partnerships and different countries. So that's an interesting framing of the situation. And therefore, we need to find ourselves into which supply chain that we embed ourselves in. And that is the kind of mindset we need to have. So the mantra or the watchword for this summit in the next 2 days is, if the country were to become strategically resilient, build leverage, what are the kind of management approaches, strategic decisions that the financial sector must take, and what kind of instruments and innovation it must bring to the table, so that in the next 10 years, we build a strategic leverage commensurate with our economic size globally. Thank you.
Thank you. Thank you very much, Secretary. Thank you very much, Chief Economic Advisor. Both of you have really given us a phenomenal booster start to this financial summit. And I must say that your partnership, your candidness, your approachability makes this government industry partnership and along with the regulators, I must say, very, very critical to see how we can find different routes of what both of you men talked about, a Viksit Bharat by 2047. Ladies and gentlemen, once again, let's join in to thank the two outstanding speakers to give a phenomenal start.
Thank you to our eminent speakers. We now have a small memento to be presented to our eminent dignitaries. And I request CB to hand over the memento to Srimati Anuradha Thakur. And to Dr. V Anantha Nageswaran. Thank you once again. Thank you.
लड़कियां शुभ काम में सबसे आगे रहती हैं। अब घर के ओनरशिप में भी लड़कियों का नाम सबसे आगे है। We are now starting the industry plenary on financing future growth, and may I invite on stage the panelist of this session, Dr. Janmejaya Sinha, Co-Chairman, CII Economic Affairs Council, and Chairman India, the Boston Consulting Group, Shri Ratnakar Patnaik, Managing Director, Life Insurance Corporation, Ashishkumar Chauhan, MD and CEO, National Stock Exchange, Kaku Nakhate, CEO, India, Bank of America, Mehul Pandya, MD and Group CEO, Care Ratings Limited, and Sandeep Ghosh, Group Country Manager, India and South Asia visa. Thank you all for joining us here today. Over to you, Dr. Sinha. Thank you.
Yeah. Good morning. It is a tough act to follow the DEA secretary and the chief economic advisor, and it's on industry to see whether they can do so. So let's begin quickly. If we were really to look at it today, financing the future is an interesting question, because there is financing the future internally and there is financing the future attracting global funds. And if you were to really look at it, half the global funds in the world are in the US. And the US is going through multiple transitions. So much so that US itself is not aware of what tomorrow's transition is going to be. So of the $124 trillion that is there globally, 62 trillion is in the US. And that does not reflect the underlying real sector. The CA had been very astute to mention that in India, we should try and keep a relationship between the financial sector and the real sector. That is one thing the US has not done. And as we speak right now, the US forward PE multiples are at record highs, almost reaching the dot-com levels of 26. And if you just were to take the top 6 stocks, they are over 30. And, if the expectations that the top 6 stocks are giving is that they must give you $650 billion of revenues from AI cumulatively. $650 billion of revenues, while right now they are hard pressed to even show you 40 billion of revenues. So the market is frothy and a lot of it is there. And even the money that was in India, a lot of it has flowed back to the US as a Pavlovian response. So it's in this context that we are really talking about the money that has flown. Now, our own stock market is also pretty frothy. We've also got a PE at around 23, the same level. So we have to be careful in not, talking loosely about what exists in the US and what exists in India. In fact, if you were to really look at it, US, Japan, and India are the only markets where the market capitalization is more than GDP. China and EU are much below. So that's the context. The other frightening context is that $18 trillion of global finance, $18 trillion of US equity is held by foreigners. 18 trillion. That is like 5 times India's GDP. And 21% of US household wealth is in US equity. Should this collapse, what will be the impact on the global economy? What will be the impact on the Indian markets? And with the financialization, so to speak, of the Indian markets, what is the likely outlook that can unfold this year or next year, but certainly before 27? So this is the question that I'm going to, pose to all of you. So Mr. Pandey, I'd like to begin with you and ask you some disparate questions. As LIC, how much of India's growth, in a sense, do you fund? And, I'll let you speak for a few minutes. So I'll throw a few more questions at you. How do you decide to allocate your money between companies and mutual funds? And what steps are you taking to increase, in fact, the money that you receive so that you can provide resilience to the Indian financial market? And also, that they should start getting up to speed with the fact that they might be rushing into a collapse in their equity markets.
Thank you and good morning to all of you. Madam Thakur, Sri Nageswaran sir, and other eminent panelists with me. I would like to start with one thing in mind, ki insurance for all by 2047, that is the premises on which LIC has started rebooting itself of late. And thanks to the Government of India for the path-breaking GST reforms recently, and I'm sure that is going to help us to make insurance affordable, and it will essay to bridge the penetration, the protection gap we are having in this country today. So as far as the fund allocation you were telling, I was just hearing animal spirit was discussed 3 to 4 times, but I would like to say to this August House, this elephant can run and dance too. So this is what we have been working, and we are governed by our regulators' guidelines. A certain percentage of our funds are invested in government papers. Let it be government securities, state government securities. But I am happy to inform around the corporate bond investments with the eye on infrastructure and housing, it was hovering around 8%. And in last 2 years, we have increased it to around 10% of our total investable surplus or the total portfolio. And as Madam was mentioning about REITs, InvITs, and AIFs, I'm happy to inform LIC has started investing in REITs in a big way. So in InvITs, as well as we are very open to good AIF funds to give a pep up to the startup economy. So as far as corporate bond is concerned, we are very confident and we look for good papers, though the minimum criteria is AA papers, but we mostly go for AA plus and AAA. But if the papers are good, the company is good, the lookout is good, we want to create that delta for our customers, investors. We are having today around 27 crores in force policies and 21 crores of policy holders. So we don't mind looking into AA papers also, but provided the lookout is good and the growth potential is matching our ALM expectations. As Dr. Nageswaran was telling, we invest in long-term papers because today, even a person aged 25 years, he can go for an annuity policy. Earlier, it used to be 40 years. So the longevity being at 70 and the person being 25 years, I have to provide come what may a guaranteed return for next 45 years. So we have started investing in the 50-year government securities floated by RBI, and we are the most probably the only insurer, or maybe few others are just chipping in to invest in the 50-year long paper, because I know this is my requirement for my ALM. So the fund allocation is this way. As far as our marketing in America is concerned, I can't comment right now, but we are open to this idea of taking ourselves to other countries. Thank you.
Mr. Chauhan, I'm going to come to you. You are sitting on a very, very worrying perch. Do you sleep well at night? If you do, why do you? If you don't, what keeps you awake at night?
This is a loaded question. And it has many other parameters other than the job I do. But effectively, I think it's a very robust market. We may try to compare with the rest of the world and try to think that we have weaknesses. It's like Sachin Tendulkar's batting. He may make 100 centuries and we may still think that he's not hitting 6 every ball. And so this is the sector which has given the best framework to the country when banks were not able to finance the stock markets have come up to finance not only in equities, but also debt. Last year, we raised almost 18 lakh crore rupees, out of which 1.69 lakh crore was equities. But that 1.69 lakh crore made us the largest IPO market in the world. And for me, even if people do OFS, they are somewhere investing. That's why they are doing OFS. It's just that they're coming late to the market, which is fine. But if you don't give them exit, why would they invest? So for me, sometimes we worry a lot about saying that why they are doing OFS, they have to do only IPO, which is true. If they do IPO, well and good. But it's the guys who have invested money are coming in. And so, like Mr. Sinha talked about India's price earnings matching America's price earnings. And also, I'll give you some China numbers also so that you understand what are we talking and why these things happen. America is currently running, sir, at around 28p, not 23 as you said. So it's at 28, 27.9 as of yesterday, looks like. And the total market cap somewhere between 65 to 68 trillion dollars. If you take top 10 IT companies, they account for almost 25 to 30 trillion dollars. It is basically nothing to do with finance part of it. And they say it's not a bubble because there is no leverage. If there is a leverage, there only there is a bubble. Otherwise, it's not a bubble and stuff like that. And so, similarly, China is currently running at 16 of price earnings. Last year, they were running at around 8 or 9. Why these things happen? Why such sort of differentials in price earnings happen across different economies? Due to a variety of reasons. China was going down in terms of its profit potential, in terms of its growth, and also in terms of corporate governance. If you look at China, today's index is the same as last 20 years back index. 20 years, people have not got any returns. Why people are putting money? This weekend, we were having a 4-hour discussion till late into the night. And somebody said they market well. And we are the worst marketeers as a company. But America is the best marketeer. So, in a way, why the AI hype? That America created a hype saying if you don't have so much compute and so much money, don't come into the AI table. Winner takes all. $500 billion or $1 trillion, then only company should come or the country should come, and we don't have it. So we were made to think that we have lost the battle. Only China and America are fighting. China suddenly came with open source, open weight AI models 3-4 weeks back. They become so good that the second most important AI model now is called Kimi K2, which is actually giving the same or better results at 100 the price, including compute, including inference, all the cost put somewhere between 1/10 to 100 the price. It has just quietly come and punctured the AI bubble in such a way that whatever you see as a $30 trillion of America has slowly now become 25 trillion. And you will see that why I'm telling you this is that we have come through a framework of not investing too much because we did not have the capital. As a country, we were capital starved. And even in IT, when IT came up, we did not invent electronic chips, nor Unix, nor internet, nor Python or any other modern languages. But we became the best users. We became the people who gave the best outcomes to the public. And last 3 years, the framework was that the compute and the inference models will take away 90% of the productivity gains that will come, and people like India will lose out. Last 2 weeks have proved that 90% what they were assuming is now going to become 5-7% or less. The remaining 93% has opened up for Indians to again provide services to the rest of the world. And that's why where we are good at, we must try pushing. And one of the reasons I still feel that we are the least leveraged banking system in the world. The banking system, GDP to banking system ratio in India, our banking system to GDP ratio in India is almost 0.6:1. In US, it is almost 4:1 or even more because actually after that, nobody knows. In China, it's almost 4:1 as declared. It could be even more. And that is where we need to understand that our banking system has actually lagged behind in funding the economy. but where to invest, how to invest, and those kind of things. If we continue to provide them incentives to not invest and still make a lot of money, today, by the way, Bank Nifty has reached the lifetime high. So effectively, we need to take away those disincentives of not funding the economy. We need to provide the incentives to fund the economy, and then you will have some sort of ideas, like somewhere if we have a little bit of sort of increase in the consumer finance, we start calling it bubble, because that's how it is. You look at the American methodology, not that we have to follow it blindly. Look at China. They go into different areas strategically. We don't, because again, we are not that sort of style economy, right? And so we have to take into account our own constraints, our ways of doing things. But broadly speaking, although NSE was the first screen-based order matching system that became successful in the world. After that, NYSE, NASDAQ used to be on phone, by the way, not on screen. Screen was to watch, phone was the trading in 1994 when NSE started. London, Japan, everyone became automated. So we have been the pioneers of the safe capital markets, but more importantly, our corporate governance is much tougher than US. Our corporate governance is 100 times better than China. And that's why people have got that trust. There are going to be ups and downs in the price earnings. 23 might not be that sort of lucrative. And that time when price earnings go up, I say that either prices have to reach the earnings or earnings have to reach the price. Today, last 1 year has been sideways. And that's why earnings are reaching the price now. And so you are going basically and broadly, the last part is economy which is going to grow fast will have higher price earnings. Japan in the 50s and 60s was running at much higher price earnings than 80s, 90s and 2000. And that has happened to Americas in 70s. That's happened to many other countries which consistently are expected to grow faster, will have high price earnings. That doesn't mean the price earnings have to be very, very high and stuff like that. But broadly, we are good students. We take, I think as Anand said, we end up taking all the best practices and try to sort of implement them, and then we forget how to play, right? So that is where basically too much of talking, very little of doing is what is the bane currently.
Thank you. I'm also just cautioning all of you that in the second round, I will want you to offer 3 suggestions to the DEA and the Chief Economic Advisor to take back to Delhi. They've come to Bombay to receive some input also. And we should just think of what we want to tell them. Kaku, I want to come to you now. What do you think is the role of foreign banks in India? And what do you think the market regulators should do or RBI should do to help you finance growth in India? And given the state of the world today, should we worry that you might be asked to leave India overnight?
I'm not worried about that, at least, because I think the policies of our countries have been always welcoming, important players.
No. I meant it the other way around. That the US will tell you that you have to get out of India.
No, I don't think so. That's going to happen. Because I think the economies are well tied up. And these are short-term aberrations, in my opinion. And at least based on all the recent reports that we all hear from both governments, I think the trade talks are moving in the right direction. So I'm quite optimistic that there would be a solution very soon. Coming to the role of foreign banks, I think time has come in the country that, we really need to think if we want to become, move towards Viksit Bharat, where is the extra financing coming from? So banks definitely, as Ashish correctly said, can play a bigger role, but for that the models have to change. Right now we are all adopting one model for all banks, but probably we need to look at different models to allow agricultural banks only to come in, to look at, a lot of structuring products, credit enhancements, things that can be done. I think we are moving in the right direction, because I was very happy to hear that we are finally considering acquisition financing onshore. Otherwise, local domestic companies had to go all the way through structures to get financing abroad. So these are things that are going in the right direction, I would say. But what we can do further, just to take the point you mentioned, Janmejaya, before, we have 124 trillion investable assets. We have done a lot to go ahead. We built a robust capital markets. We were the first ones to do T+1. We were the first ones to do 24/7 NPCI through all payment, not just NPCI, but with RBI, all payments. So we have been taking leads on many other ecosystems globally. But with that, there are challenges also that we are facing, and we are really leading, like fraud risk management. When I talk to the US, right, they don't face that much as we are facing, because we are every nanosecond doing a transaction, which is settling in half an hour. So things like this is going to be key, and we will have to really tread carefully, which we are, but these are big things. But what we are not doing enough, let me say, to the 124 trillion assets, we are only attracting less than, or we are attacking less than 1% of the investable funds in India, while our global GDP contribution is 4%. So that's a big gap. So we have attracted long-only funds. We have started attracting debt funds now with our inclusion in the indices. But what we are not doing enough is multi-asset class funds or private credit funds. If I just take from 2016 to 2025, the multi-asset and private credit funds have gone to 1.5 trillion, tripled in just this many years. We are at 9 billion. And just last year, not last year, current year, if I may say, calendar, 140 billion private equity credit funds have been done. And there's a 335 billion ammunition, because it gets built, over a period of time, which can be drawn up. And we have a very little small part of that. And as you correctly put it, that markets have become volatile. Big HNI and monies are going into private credit funds, at least to 25-30%. So we really need to work towards attracting that and high net worth families across the world into the India to really finance the growth. I must say LIC has done a lot of change, and I welcome, sir, you all participating in the IPO market finally, which was very pleasant, and REITs to the government to allow it to be treated as equity after a long debate on debt funds. So these are all in the right directions, but we need to do a lot on private credit funds. And foreign banks can actually really work together on credit enhancements, structuring, and also distribution of these assets globally. And that's where I would really put the most important finger on what we should be doing.
Thank you. Mr. Pandya, we don't know each other well, but I must caution you. You're sitting that said, I must caution you. I tend to attack credit rating agencies whenever I see them. So you are in the firing line, and I want to just caution you. I have not been able to understand over so many years, why is it that India's ratings don't reflect any reasonable economist's view of economic growth and potential? If we were to really look at it, since 2009, Greece has had 9 credit rating upgrades. And then finally it went above India. And then the one concession that your competitors did was to bring India to the same level as Greece. And now whenever I think about economies, I don't think of Greece as our benchmark economy. So why is it that despite 30 years of 6.5% growth, low foreign debt, total government debt being below 90, what are we missing? Why can't India's credit rating go to a level where it can start attracting long-term funds, pension funds and insurance funds into India, which will benefit them, benefit India, and will also suggest that credit rating agencies have woken up. I'm sorry I had to put you in the spot, even though you don't belong to Standard & Poor's and Moody's. You will have the freedom to criticize them.
Yeah, thank you, Dr. Sinha. I think you are referring to the perceived inactive or perceived bias in the ratings, and I allude to that in the sense that, see, when the recent upgrade by one of the global rating agencies happened, we were also pleasantly surprised in the sense that why it took 18 to 20 years for coming to that. But we were also quite energized by the fact that we had already taken a step almost about a year back. Because when we ventured through a subsidiary into the sovereign and global scale ratings, that was about a year back, October 2024, through our CareEdge Global Ratings based out of IFSC GIFT City. And we rated 39 countries, of which India was a part of that. And without any home country bias, we had rated it at BBB+. And then to see a few months back, somebody upgrading India to BBB, we were also wondering that in this last 18 to 20 years, there were enough and more triggers which were why they were overlooked, only they can answer. Right? But the fact remains that India certainly deserved better. And we had already taken the step. Having said that, I think one of the aspects which has played out, as has been given to understand, has been the higher debt levels. But let's also take the overall construct into our mindset. First and the foremost thing is that India has demonstrated significant economic resilience through its fiscal discipline. Second aspect is that we have a very credible inflation management. Third aspect, both the principal regulators, the capital market regulators, SEBI, and the banking regulator, RBI.
Be careful, the SEBI regulator has now entered the room, so don't say anything.
Full respect, right. They have displayed and demonstrated time and again the resilience of the regulatory structure in this country as compared to many so-called developed economies, and we must take pride in that. Despite all these things, the ratings did not move. And when we approached this entire thing, one thing which we realized that there has been heavy emphasis on some of the parameters like per capita income, real growth rate, and we try to reason it out through intense deliberations with many of the multilateral agencies as well. And we try to differentiate it by bringing in nuanced parameters in the form of, like, say, per capita income is important, but we try to bring in the parameter in by linking it to the PPP terms. The second aspect was a growing economy like India always requires a lot of investment, and we brought in the parameter of GFCF as a percentage of GDP to be looked at across the economies. Sustainability is one aspect that the government has quite been focused upon. It's a primary driver for us. External debt, I mean, this is one of the biggest strengths for India in the sense that while we talk about the total gross governmental debt, but how much is the external debt as compared to many other economies? It's a clear-cut parameter which required quite a different approach on this, and we brought it in. Right? So because of this, 50%, we had a 50% divergence against the major global rating agencies. And this was across the spectrum. It's not just case of India. I mean, it has been across the developed and the emerging economies as well. And what is heartening is the fact that in 1 year of our operations, we have seen convergence of the ratings on 17 countries out of the 13 that we have rated towards the ratings that we have that has been assigned by us. And mind well, we have only 1 year of operations. You'd like to see more of that going forward. You mentioned about Greece, a classical example. Right? Once again, our rating for Greece is BB+, right? And our rating for India is BBB+. It's a one full band rating difference, right? to equate Greece with India by putting it at triple B, I think a lot of aspects they need to be considered. If I were to pick up that economy, the fact remains that its overall GDP, it's still below the level at which it was prior to the global financial crisis. Right? It has a significantly large external debt. Its net NIIP is minus 110%, much higher than what India is having. Right? Having said that, it also gets the benefit in the form of being a part of the Eurozone. Right? It's a part of the reserve currency globally. And a significant chunk of its own debt is euro-denominated. So these are the advantages that it had. But let us also not forget the fact that that was a similar situation when it actually defaulted. Right? What we believe is that the past track record of default or a default-free track record also needs to be considered by the rating agencies. And India has an impeccable track record even during the financial crisis or the currency crisis of imbalance in 1991-92. We did not default. Right? These are the aspects that need to be brought about. And I do believe that going forward, there would be much and more, you can say, realization on this aspect, and we should see greater convergence than what we have. I mean, today 17 ratings, country ratings have moved towards our rating. I wish there will be more. Right. Thank you.
I think I like you more now. Yeah.
I think one thing I would say, we should be pushing gold reserves versus US Treasury investments, because that is changing for Asia, and that's not being considered by credit agencies.
Yeah, in fact, if there is one suggestion I can give to the very august group of people from the Ministry of Finance and SEBI, is that we should be doing a conference trying to call foreign bank CEOs and the 3 credit rating agencies and to have a real discussion, public discussion around how they justify their ratings. Because it has a lot of implications to long-term capital for us. And it is inconceivable for me, because when you have discussions, when I go abroad and I talk to these foreign banks and companies investing in India, their view on India is completely at odds with the rating agencies, and it has very serious consequences for us. So I think this is something that we must take on, and all the points you were making, I was very happy to hear. Now, Mr. Ghosh, as I come to you, firstly, as Visa, do you worry? With all the payment changes that are taking place, there must be a lot of concern about the future of how you will, with NPCI a threat or not. And then when you look at crypto and stable coins and central bank digital currencies, do you think that Trump's $3.6 billion that he has made with the Trump dollar is the only reason for this, or are there other good reasons for stable coins?
Good Lord. I don't know about my other panelists, but I might have some sleepless nights answering that question, but I'll take a shot anyway.
There's no media. Whatever you say will not be told in the US.
Absolutely. No, but very good morning to my fellow panelists, distinguished guests, and everyone in the audience. So actually, looking at it from a Visa lens, we see 2 things. One, the pace of innovation and disruption in the world of payments in the last 5 years is more than what's happened in the 50 years preceding that. And that is actually a huge opportunity for us. And I don't know if I get any credit for it or not, but even the competitive playbook in India actually sets the stage for what's going to happen everywhere else in the world. So what I tell my global leaders is, what you're seeing here is a movie coming to every other market in the world. It's just a matter of when and not if. So we've kind of really set that tone with everything that's happened. And we often talk of UPI Janmejaya as the poster child, which it is, but it's the whole infrastructure, the Jam Trinity, all the RTP offerings that we have, from RTGS, NEFT, IMPS, the works, and UPI, of course. So there's lots for us to learn. There's lots for us to also benefit from, because despite everything that India has achieved, and I'm extremely grateful that both the distinguished speakers talked about things like democratization of credit. Now, what UPI has managed to do is democratize digital payments. What India still lacks is democratization of responsible credit. And I'm speaking of it from a consumer lens, because for a country our size, we have barely 110 million credit cards in the country, and only about 50 or 55 million of these are actually unique cards, because folks sitting in this room probably have 2 or 3 cards in their wallet. Now, how does that compare with China? China has 1 billion credit cards, 10x of India. Yes, their economy is 6x of India, but their credit card base and penetration is 10x of India. Brazil is a multiple of India. So we have some distance to cover when it comes to, and I just don't mean credit cards, when it comes to responsible, secured and unsecured credit for the common Indian, for the small businesses out there, we have some distance to cover. The second area where we are still sort of lagging behind is the adoption of what I would call open loop, account-based ticketing in urban transit. So in many areas, we lead the world, but when it comes to transit payments, we are 10 years behind what the UK, what Australia, what Singapore, Hong Kong, the US are, because we've gone in for this NCMC mobility card, which is a closed loop system. And without getting into the technical differences, if you travel abroad, you can pretty much pull out a card from any country issued by any bank, whether it's a debit card, credit card, prepaid card, and you go to the London Metro or the Hong Kong or Singapore metros and you just tap and pay, and you can not only use it in the metro, you can use it in any form of urban transit system through the day, and it's seamless, it's frictionless, and we've gone and adopted something that the rest of the world abandoned 10 years ago. So high time, you talked about suggestions that policymakers across MoHUA, Ministry of Finance, RBI, reconsider the decision to go closed loop and think about why we should have a system which is any different from the best in the rest of the world. Very recently, the RBI also adopted a new guideline around alternate forms of authentication. The time has come for us to also now move beyond this OTP-based authentication. The short messaging system on phones was not invented for banks to authenticate customers and to prevent fraud. It's again something that became a sort of evolution over time. And the world is kind of moved now to biometric authentication and much better forms of authentication. RBI has adopted that guideline. One of the consequences of that is we are likely to see in the next 12, 18 months, Apple Pay coming into India. That will also get Google, Samsung, and the other providers to up their game. And then you're going to see much better forms of authentication, because one of the things that all of us in this room worry about is the frauds and scams and things that are also pervasive in our digital payments ecosystem that keeps us all definitely up at night. So more risk management tools, the leveraging of AI and machine learning to prevent that, and better forms of authentication is all part of that story. So there's a lot going on there. Just moving to things like stablecoin, I think India has been very clear we were not fans of crypto, but a stablecoin adoption backed by fiat currency, provided there is transparency in terms of what reserves the issuer is holding of those fiat currencies against which the stablecoin is being issued, does offer significant advantages. It brings about unprecedented scale, efficiency, cost reduction, particularly when it comes to cross-border payments and remittances, which is an area where I know that our policymakers and regulators want to bring costs down. So we at Visa are very bullish about stablecoins, obviously, if it's adopted with the right kind of guardrails. And we think there's a long-term future for stablecoins, which are backed by fiat currency. So lots going on. I just feel that in this market, there is so much growth to accelerate digitization, democratize responsible credit, bring the best of AI, ML to risk and fraud prevention. And then my example of transit payments, where we are unfortunately 10 years behind rest of the world, much as UPI may be, beating a lot of records. So there's always areas where we can learn and improve. So we remain extremely bullish about our prospects and prospects for digitization in India.
Okay, thank you so much. And I like the fact that you make some suggestions. Okay, now I'm just going to be transparent. We have 11 minutes left. Being a very nice moderator, the 4 minutes I had retained for myself, I give to all of you, which means each of you gets 2 minutes. You, and then I'll come last to you. So you get the last word, but you better make it a worthwhile word, okay? So now, Ashish, let's go with you. 2 minutes, give some worthwhile suggestions to the August group here.
Yeah, I think since it was mentioned also, and now SEBI Chairman is also here, one is on the derivatives. I think we should standardize on how to count volumes. We have been impressed by the notional to premium ratios. I mean, the notional is absolutely on like last Thursday, Sensex was trading at 20 paisa for a 80,000 rupees contract. We were counting 80,000 rupees, not 20 paisa. Why I'm telling you this is, it's like the rest of the world, and we think we are the largest market in derivatives. We are by far not. America, on premium terms, in stock options alone, does around 5 times more than India every month. Tesla alone does sometimes more than entire India. So we have just made up in our mind, and then we are going only for those kind of statistics, which is creating wrong policy making. So I just wanted the policy makers, all three are here. So hopefully we will have some understanding of how actually where we stand, whether it is still large or not, how to remove it, how to reduce it, how to make it more safe, secure, less people, less knowledgeable people should not come. All those things are over and above that. But once we have right statistics to look at, then we will have a what I call a right policy coming out. So that was one part. The other part is that FPI regulations have become very tough over last several years. And the amount of information we ask for is very, very sort of intrusive. And many of them do not want to actually give that information. And so they are staying away. So effectively, we need to worry about whether we don't have the queue which we used to have for FPI registration because we have become more efficient or they've stopped coming, right? So that is another part we need to be very clear about where we want to work on. The third part is the centralized finance versus decentralized finance, especially the Stable Coin and Genius Act and all. For me, as soon as you go decentralization, all the PMLAs, all the taxation, everything has to be sort of given up. Once we get bullish on that, and after that, there might not be anything backing that, although people may keep on declaring what they have. And it has happened in the world market before. And so for me, the stable coin is basically what I call Trojan horse, which has been introduced. But centralized versus decentralized finance, why? Because the blockchain also can be contaminated. It has been sort of made to believe, everyone thinks that the blockchain is ultimate, it cannot be contaminated, or that is not true. It can be contaminated, and somewhere along the line, we need to worry about all this going forward. Today, other than that, for me, when we worry that why we are not using so much capital for our growth, because there is an economic theory which we have come out with that capitalism requires a lot of growth which will create jobs. We have created literally millions of jobs over the last 20, 30 years without putting too much capital in that area. We may have put in more capital in industry which did not create more growth nor many jobs, but services we have We are winning in services. Let's
Ashish,
work on services.
Ashish, I don't have more time to give you. Okay, so now let's go to Mehul. Let's go to you.
Thanks. You had only cautioned me about the presence of a regulator in the room, but I'm still taking my bet on mentioning the first point as far as the suggestions are concerned, is in terms of advocating for a light touch principle-based regulation. Emboldened by the fact that there has been similar thinking at the regulatory level also on that, because that does not mean deregulation. It's already a lot of discipline has been instilled as far as the regulated entities in the corporates. There are a lot of financial discipline, a lot of compliance discipline, which never would be undone. Right? Having said that, the second suggestion which I could be giving is in terms of the deepening the capital markets, especially the bond markets, as the CEO also and the Secretary also mentioned about that thing. It's hard time because these mere statistics in terms of 75% of the bond market dominated by the financial sector and 80% of that dominated by the AAA and AA rated bonds. So that warrants a lot of thinking in terms of how to deepen that thing. Maybe we can think of pooled finance, we can think of guarantee fund, right, giving fillip to the municipal bonds. Maybe I may suggest absorption of the EL ratings in the bond market as well. The third suggestion which I could be giving would pertaining to the diversified supply chains, where I would suggest that aggressively and coherently trap the alternative global markets, because we have seen what kind of disruptions can potentially arise, and we are living in a people talk about the disruptive global economy. I would say it's mischievous in nature also, right? And we are all taught in the school that how to deal with the mischiefs, in the sense that either you change it if you are able to, or if you don't change it, you have to change your attitude. So that's where we'll have to just go about that thing in terms of finding things. Good work has been done, but maybe through more agreements and collaborations we can do. Thank you.
Okay. Thank you. Kaku?
The first recommendation is something I talked about, attracting or setting up a risk framework and investment framework to get more private credit funds into the country, to attract more than 3% of investment $1 trillion available. And I think we are best placed because RBI, SEBI, and Finance Ministry are working together, and this can be very much possible in this regime. Second one I would say is on IPOs. Our IPOs are becoming bigger and bigger, and we had seen that first with LIC when Sir himself had pushed for the minimum limit to go to 5% of the capital. We should now take it down to 2.5%, and I know it's under consideration. That would really help for bigger IPOs, and a more reservation to be done specifically for insurance funds. So the anchor block to be moved from 33 to maybe 50% overall, and maybe insurance itself could get another 10%. And final, I would say, from banking perspective, with trade being so volatile, export financing needs really larger or longer tenure of 15 to 18 months and not a 9-month cycle, because things can change, and we should really equip more of our exporters to have steady consideration and not be marked as NPAs.
Thank you. Mr. Pandey. Mr. Patnaik. Oh, sorry. I'm so sorry. That is my fault. And I even took you into the wrong state. You have the last word.
All said and done, the insurance penetration in this country after 25 years of opening up is still 2.8% to the GDP. And whereas it is in South Africa 9.2%, Singapore more than 7%, Taiwan 7%, even Japan is 6.8%. So is the case with the insurance density.
In India, it is just $70 as far as life insurance is concerned, and other Western countries, we just can't compare it. So LIC is all poised to do well and provide the funds for the future for any kind of financing, let it be corporate bonds, government securities. So I've got 2 to 3 small suggestions. And first, while thanking for making insurance GST free,
but my small request will be, it is zero zero taxation, can it be GST exempt? So that will help us to have some input tax credit in place. So this is my request number one to the highest authorities present here. Second, as far as infrastructure and housing is concerned, each insurer has to invest at least 15%. All these years, we could reach around 9.5%. But as far as GSEC and SGS are concerned, our investments are much more than the mandated 50%. So can a part of the excess over 50% can be treated as housing and infrastructure, since these funds are utilized by the Government of India or state governments towards infrastructure and housing mostly. And my third request will be the premiums with more than 5 lakhs. The maturity proceeds are not tax-free as it used to be. And the 5 lakh limit was placed some 3 years back. Is it time to just upgrade, revise upwards that, so that more than 5 lakhs or up to 10 lakhs, it should be, the maturity proceeds should be made tax-free so that we can get some good big ticket policies and mop up good funds.
Thank you. It's been a real pleasure to moderate this panel. And we got, do you have any specific point? Quick, one point.
Just literally one point. I already talked about the transit payments. I think, again, as industry, government, regulator, a little more transparency and little more collaborative work looking at what's happening globally on combating digital fraud and scams. I think that's just an area that we need to do more.
Okay, great. So this has been a pleasure and privilege to have moderated this panel, and I'm glad we got some suggestions to the the senior ministry officials who are here, and the SEBI chief. I will say that the issue of financing India's growth is critical, and I really liked the point that you made, Kaku, that if we get 4% of the private funds into India, that can allow us to have a convertible currency. That's the amount of funding we are talking about. So this is a very important issue. As we think about the future, it is a pleasure, it's a matter of satisfaction that the retail investor has become more demanding, is looking for better returns from across the spectrum that's on offer, and banks are needing to innovate. And the fact is that for our future, we should be thinking about this. And I wanted to just put in one suggestion of my own, which is that, we got rid of development finance institutions in 2000, 2001. We really need to think about whether that was a good decision or not. We did that in discussion with the IMF at a time when, our bargaining power was much less than theirs. I think it's time for India to really start to think seriously about a couple of development finance institutions which can actually think about long-term projects and actually financing them and figure out the mechanism that can allow them to exist and operate in a manner which is sustainable. Thank you so much. It's been a pleasure moderating this panel.
Thank you so much. We request everybody to remain seated. We are ready to start our next standalone session with the SEBI chair. Requesting members to kindly settle down. May we now invite on stage Shri Tuhin Kanta Pandey, Chairman SEBI. With our moderators, Mr. Chandrajit, Banerjee, Director General CII, and Dr. Janmejaya Sinha, Chairman India, BCG. May I request members to kindly settle down? We're ready to start with our panel.
I'll request all of you to kindly take your seats, please. Ladies and gentlemen, on the first row, it's like almost like the well at a well-known place. Could we have you all to take your seats, please? We have the SEBI Chairman here, and I'll request your indulgence and come. Excuse me, my colleagues, would you get them to sit down, please? Excuse me, gentlemen, if you could kindly take your seats, please. Don't wish to call out your names, otherwise I will have to kindly. Please, thank you. Good afternoon, and Janmejaya just declared himself to be the best moderator, and therefore I dare to, come after him, but the moderator was only 2 minutes late in concluding the session. But Janmai, thank you for always leading it, and I must acknowledge Janmai and Dinesh, both who lead this work as chairs for CII, and it's an honor, delight, and indeed a pleasure to welcome Shri Tuhin Kanta Pandey, the chairman of the SEBI, in our midst for this financial summit. The first session, Mr. Chairman, it was only praise about you. As I was receiving you, I was mentioning there was so much of praise that went on. But when Janmai chaired, the best moderator chaired, he knows this way of Dil Mange More. So he got people to come out with all the Dil Mange More for you, as well as the DEA secretary, to see to it that we get more stuff punched in. But in such a short span since March, you have set indeed a very clear tone, and I'll rather talking about the content, which I leave to the greater moderator, Mr. Dr. Sinha. I know my leg will be pulled till death after I do all of this. But Janmai, I sincerely would request you to take on the substantial part of it, but wanted to sincerely convey the type of appreciation that we hear from the industry, the clear tone, the regulation, the regulatory changes, the ease that you have brought in. And I'll just pick on a few to talk about. Number one, of course, simpler and smarter regulations that one has seen. The chairman, you've really championed reforms that make it easier to operate in our markets. Indeed, you have simplified compliance frameworks to reduce our paperwork, and much more you have done. And in your own words, if one can say, how do we keep oversight strong but the experience smoother? And I think that's what your leadership, the introduction of a unified contract note system, ease norms for intermediaries, has been just great. Second, if I can talk about the investor protection being at the core, at the time when we have seen volatility, foreign large outflows, which was talked about, you doubled down on transparency, safety, and long-term confidence. That was phenomenal, and really do appreciate once again. And you talk to industry, talk to our membership, that's the feedback that we get. Third, the technology and transparency in governance. And your vision really can be summed up probably in 4 T's, if one can say, or trust, transparency, teamwork, and technology. Your upgraded, the way you upgraded the surveillance system using AI and data analytics and technology, for you it has been a tool of real trust, speed, and fairness. Fourth, if I may, thank you for your openness to ideas. Refreshing indeed in leadership style. You are being described by people again, and I quote it from our membership and people who have been, you have always been interfacing with many, many stakeholders, and that collaborative approach and the accessibility, light touch, but firm, has been of great, great value. And fifthly, of course, attracting of global capital, your practical steps that you have taken to make India more attractive globally, speeding up FPI registration, re-examining transaction cost, reviewing netting, and short selling rules, much more than one can go on. I could go on and on, but then I thought that one must look at some of these in terms of conveying to you. There is a deep gratitude from the Indian industry towards you and for the phenomenal changes that you have brought in, and the confidence that you have given in, be it modernizing market frameworks and other points that I have taken. I wanted to say that as one welcomes you to the Financing Summit, and we really look forward to first listening to you and then maybe getting into a short discussion with you. Ladies and gentlemen, join me once again in welcoming Mr. Tuhin Kanta Pandey.
Distinguished leaders from industry, professionals from investment funds and intermediaries, and partners in our nation's economic journey. Good morning to you all. I'm really delighted to see Anuradha here sitting, Secretary Economic Affairs, a fantastic officer and very, very suitable for economic affairs, and she would really be able to absorb a lot of things and synthesize, and hopefully you will see great budgets from her. I mean, budget inputs from her to the finance minister. It's always energizing to be among people who understand that India's capital markets are not merely transactional platforms. They are in fact public institutions, institutions that touch the lives of millions of households, shape the future of thousands of enterprises, and increasingly influence the very direction of our national development. Today, I want to speak to you about how India's security markets are evolving, not as a set of isolated reforms or individual data points, but as a larger, coherent transition, a shift towards markets that are deeper, more modern, more inclusive, and ultimately more aligned with India's aspirations over the next decade. If we step back and view the last decade as a whole, a clear arc becomes visible. The Indian security market is no longer a peripheral source of financing. It's now a central driver of India's long-term investment cycle. Consider this. Over the past 10 years, capital markets, equity and debt together have facilitated average issuances of roughly 9.5 lakh crore every year. This is a capital that flows wide and deep through circulatory system of body economic in all kinds of sectors, from manufacturing to services, from physical and digital infrastructure to connectivity and logistics, from clean energy to semiconductors, from high-end research to startup-driven innovation. from banking and insurance to ever-expanding fintech industry. Even in the current financial year, from April to October, equity capital has crossed 2.5 trillion rupees, while corporate bond issuances have touched almost 5.5 trillion rupees in the first 7 months. These numbers reflect something deeper than market buoyancy. They reflect confidence among issuers that public markets can meet long-term financing needs efficiently, reliably, and at scale. A decade ago, outstanding corporate bonds stood at around 43% of bank credit to industry and services. Today, they stand at nearly 55 trillion rupees, close to 60% of bank credit. This move towards market-based financing reduces concentration risks, diversifies funding channels, and strengthens the overall architecture of financial stability. India's market capitalization to GDP ratio, a broad indicator of the role of capital markets in national wealth, has moved from around 69% in FY16 to more than 130% today. This is not the story of a market growing on sentiment. This is the story of an economy whose productive sectors are increasingly funded through transparent, fair, and competitive market mechanisms. Similarly, the growth of mutual fund industry from 12 trillion rupees in FY16 to nearly 80 trillion rupees today signifies the emergence of millions of first-time savers as stakeholders in India's growth, and the rise of the AIF ecosystem from a modest 0.2 trillion in FY16 to more than 6 trillion today marks another shift. Risk capital is flowing into startups, early-stage ventures, and new economy businesses at a scale that was unimaginable even a decade ago. These are not isolated developments. They are interconnected signs of a maturing financial system. The evolution of our markets did not happen by itself. It has been rooted in a steady reform agenda, not dramatic overhauls, but thoughtful, calibrated, and persistent improvements. One of our key priorities over the last few years has been simplifying market processes so that every stakeholder, issuer, investor, or intermediaries interacts with the market smoothly. For example, the digitization of onboarding and the establishment of a unified authenticated KYC framework in securities market through KYC registration agencies, which we call KRAs, have reduced duplication and made access more seamless. These are changes that save time and reduce compliance burdens, especially for small investors and new entrants. Going forward, the proposed CKR-CY 2.0 with deduplication and authentication and interoperability with KRAs will provide a seamless KYC for the entire financial sector. We must also enable, with technological and regulatory changes, KYC and DMAT account opening for NRIs at their locations abroad without the necessity of their presence in India. For FPIs, we propose to shorten the registration process to just a few days by not only streamlining processes, but also by persuading FPIs for submission of digitally signed documents. A new website is now functional for providing information about India investing by FPIs at one place. For common application form, the front-end interface has been recently improved and more work on this is in progress. Reforms in block deal framework will help meet a long-pending demand from investors. Similarly, the introduction of the common contract note with a single VWAP for institutional trades may seem like a small operational reform, but it enhances clarity in institutional transactions, improves audit processes, and reduces discrepancies, all building blocks of trust. We are also close to enabling closing auction mechanism in our market after having widely consulted on the matter. We have also undertaken important steps to improve the experience of issuers. The rationalization of minimum public offer scale-based thresholds that allows companies with substantial market value to achieve public float requirements through a gradual, orderly process instead of rushing to dilute ownership. Enabling founders to retain certain ESOPs post-listing measures that the alignment of incentives remains intact while at the same time maintaining transparency and fairness. Similarly, expanding the scope of electronic book provider platforms to include REITs and InvITs has strengthened price discovery in these fast-growing market segments, which are now playing a central role in financing India's infrastructure. And by lowering the threshold for mandatory electronic book mechanism usage in bond issuances, we have improved transparency in price formation in the corporate debt market. A market can deepen only when both supply, whether it's new equity, debt, and other issuances, and demand, which is the investment by investors, evolve in a balanced manner. In recent years, efforts have been made to expand participation from smaller towns and underserved segments. Revised distributor incentive structures now encourage onboarding of first-time investors from B30 cities and aim to increase women investors in the mutual fund industry. This is not just market development, it's financial inclusion of a profound kind. But the investor inclusion is meaningful only when it is accompanied by trust in the system. For this reason, we have introduced reforms that are increasingly focused on transparency in disclosures, accountability, and prompt identification and mitigation of risks. On governance of market infrastructure institutions, exchanges, clearing corporations, and depositories, well, these are the foundation elements of the securities ecosystem. Their governance must be unimpeachable. To strengthen governance of MIIs, we have mandated that in addition to internal evaluation, the performance evaluation of MIIs and its statutory committees would be done through an external independent agency once in 3 years. For improving board governance of MIIs, new guidelines have been issued for appointment of key directors. In derivatives market, after wide public consultations, we have taken a number of measures in October 24 and May 25. These measures have been rolled out in a graded manner as per an implementation roadmap. We'll continue to monitor the data and the market. SME platforms have opened new avenues for smaller enterprises to raise capital, but the integrity of these platforms must remain high. Enhanced scrutiny and stronger governance norms for SME issuers are designed to ensure that the platform remains credible, protects investors, and fulfills its objective of nurturing growth enterprises. Looking ahead, our agenda is not about adding more rules. It's about shaping a smarter rule book, one that is simpler to understand, proportionate to the risks it seeks to address, and supportive of innovation. A comprehensive review of SEBI's regulations is underway after due public consultations, an exercise intended to eliminate redundancy, remove ambiguity, and update outdated constructs. The process is well advanced for SEBI stockbroker regulations and SEBI mutual fund regulations. For settlement and LODR regulations also, the preparatory work has started and public consultations will follow. The goal is clear: a regulatory architecture that is contextual to our present and future needs, unambiguous, easier to comply with, and more effective to supervise. To ease the process of fundraising for IPO-bound companies whose pre-IPO shares are pledged is being streamlined. We are proposing a new framework which will ensure that lock-in requirements get automatically enforced even if the pledge is invoked or released, thereby preventing listing delays. We are also proposing to rationalize the existing contents of the offer document summary. This summary will also be made available separately to investors from the offer document to reduce their reliance on unverified social media or grey market tips and encourage informed feedback from them. With the introduction of the offer document summary, the requirements of abridged prospectus will be dispensed with, reducing the compliance requirements of the issuers. Regulation can guide, enable, and correct, but true market quality emerges from the conduct of its participants. Institutions must lead. Boards must pursue higher governance standards. Intermediaries must embrace excellence beyond compliance. And market participants must operationalize integrity in daily practice. I urge corporates, fund managers, and market participants to adopt best practices proactively, to invest in capacity building, whether in cyber risk, data ethics, or behavioral governance, and to treat transparency as a strategic advantage. To conclude, the securities market is no longer a passive mirror of the economy. It's an active partner in national building. The numbers I shared are the outcome of collective effort. The reforms underway are the roadmap. But the future, we realize, will be determined by the depth of our partnerships between regulators and industry, issuers and investors, urban capital markets, and emerging savers in smaller towns. Let's therefore commit, as regulators, industry leaders, and citizens, to shape markets that are deep, inclusive, and globally competitive, markets that allocate capital efficiently, protect the small investor, and fuel a growth story that is sustainable and shared by all. Thank you.
Yes, Janmejaya, you're threatening me with the mic, please.
Firstly, I must make a confession. I like the SEBI chairman. I like him because he didn't embarrass me when he could. And I'll explain. I had been writing ceaseless articles on why in the Indian banking sector, the government should be the single largest owner, but below 51%. And he was DPM secretary, and every time, people would say, why is this not happening? Then we were on a panel together, and we were sitting in that speaker's lounge, and he came and told me, you must stop writing these articles. So, because it's not that I disagree, it is the Supreme Court has said that if the government is the single largest owner, we will treat them like public sector. Now, it requires a great degree of decency to have somebody keep writing articles repetitively and say nothing. Then we went on to the panel. He gave his speech, said nothing. And I felt so awkward that I had to publicly make this confession which I make today. So I have to confess that I like you. And it's also a very rare quality. When you can rub somebody's nose, then you don't do it. So, my nose is intact, as you can see. I would like to ask you a couple of simple questions, actually. Of the priorities that you highlighted, what are the 2 or 3 most pressing for you? And also, what keeps you up at night?
I think I'll answer the second question first. Nothing keeps me up at night.
because that is useless, because you have the whole day to do a lot of work and the next day will be gone. The second thing I see, at least in Mumbai, I find, there is huge amount of talent, both internally within SEBI and externally outside. And we just have to work together to make the magic happen. So I think it is like the moment we really take our blinkers off, things start happening.
Now I'm going to ask you the final question before, should we go to the floor or no? Okay, so I know you've got a time constraint, but I will ask you that right now there is a lot of froth in the US market, which can have implications if it comes down. If the US market was to correct, 21% of US households have investments in the market. And depending on what range you take, there could be a 6 to 10% wealth effect, which might have a compression on the US economy and on the global economy. In a situation like that, do you think there will be panic and money will go out of India or come into India?
I think if you would have seen the trends over a period of time, we really see the rise of domestic investor in a big way. Now, individuals itself, they hold, more than 17, 18% of the listed markets. We do have DIIs and individuals put together. Now, FPIs are actually under 17% today. So one is that this process, which is the more 135 million investors, unique investors, the institutional investor, the mutual fund industry. This is the industry which believes in India's story, because India's story is not really built on any bubble. You have a very strong economic growth which is happening. And there is a demographic dividend, there is a talent pool. Government is investing in infrastructure, and private sector is investing too in different things. And I think more needs to be done by possibly the private sector. So going forward, this growth is the main reason how we would be able to deploy our internal savings and more savings into our capital market. There will always be risk, and there have always been risks to external risks. Whether it is trade related or whether coming out of the stock markets or the financial markets. But I think whether it is RBI or SEBI, we have been working together always, and we have a fair amount of models on interconnectedness and how it happens when you have redemptions, what happens when there is so mutual funds have to do, for example, stress testing, and have to publish those results on public basis as per our guidelines. So these are the things that we have built up over time. I would not like to comment on what is going to happen in US market, because the jury is still out in terms of whether it is overvalued or undervalued in the current context, and different commentators have their different views. But be that as it may, I can say that internally, we have to really look at our own economy, the fundamentals, the reforms, the ease of doing business, the capital growth, the investments, and sustain this growth. And when that happens, which is also propelled by the trust of the investors into this market, I think that will really be the shields against the certain shocks that might come.
Thanks, Janmay. And Chair, one of the things that you have been really focused upon is, technology, and today with a whole lot of rapid adoption of AI, tokenization, algorithm systems across the global markets. What's your thinking about regulatory sort of a based or a market infrastructure framework that would support innovation more and while safeguarding, of course, stability, which is so very critical, and of course, also investor confidence.
So our motto has been, our regulatory stance has been innovation with responsibility, innovation with accountability. So therefore, innovation is unstoppable, and I think we will be foolish if we don't promote innovation. Innovation is, particularly the young talent that we have is brimming with, ideas in order to do that. We have to, in fact, do more in terms of R&D. And then we can always have, responsibility attached to it, the accountability attached to it. And there lies our, not only, that means we need to be very dynamic. We need not be static, and we have to move with technology. And we should put and interact and put together the best of the minds in order to see how those risks would not spill over to us. So de-risking while still providing innovation has to be the thing, and it's not an easy thing to do, but we must make commensurate efforts to do that.
In the earlier sessions and always whenever we have sessions of this kind is reference, of course, and obviously to the gift city as the financial hub. And what more do you see that's critical in terms of reforms or enablers that you see that would be needed or forthcoming to scale gift city into something which will be really meaningful in terms of the global capital flows?
I think that will not be wise on my part to comment on a fellow regulator. There is a regulator there. So I would be more inclined towards, to the extent we can facilitate it, we are facilitating. But I think as a domestic market regulator, for us, it's very important that our markets remain, to the best of the standards in the world.
Right. Janmai?
I have to looking at the audience, I restrained myself on a loose comment I was about to make on the gift city and in liquidity needed, but I won't go there. And the final question that I will ask you is, in the next 3 years or 5 years, what will you look at that will make you happy about the role that SEBI will play?
We are looking at double the numbers of the investors. So I think that is more than populations of several countries put together. I mean, if we add another 100 million investors, and that's our survey shows, that when we have the very large survey that we have conducted for the first time, shows that 63% of investors are aware of the securities market. Only 9.5% of the households are yet invested. And 22% of the households are looking at investing in the securities market in some way or the other in the next 12 months. Wow. Which means a very big responsibility on all of us. I would say both regulator as well as the industry participants, and as also the issuers. Because so that we need good quality papers, people forming companies, investing companies, building companies to scale, bringing them to the public market, private market, private credit, getting into the private listed space, and then that listed space, listed companies coming to the public markets is a continuum. We need to lots of activity of diversified nature with diversified risk to have these investors who are intending to come that. That's one part. The second is the educating investors. And how do they come in safely, responsibly? And they don't deal with, they don't get, defrauded by because when we have speed of digital infrastructure, we also have a speed of siphoning of money through cyber frauds. So this particular responsibility is the one where if we are able to discharge well in the next 3 to 5 years, obviously our capital market will be obviously of a different level in next 5 years.
Wonderful. So I'd like to bring this session to an end with a new dictum that the SEBI chief has given us, which I loved, the IRA of the future, which is innovation with responsibility and accountability. Thank you so much.
Thank you so much, sir. Thank you very much. May we request our moderators, CB and Dr. Sinha, to kindly hand over a little memento to SEBI chair, please. Ladies and gentlemen, we break for lunch and we congregate here again at 2 p.m.
लड़कियां शुभ काम में सबसे आगे रहती हैं। अब घर के ओनरशिप में भी लड़कियों का नाम सबसे आगे है। पढ़ाई में लड़कियों के नंबर अक्सर ज्यादा ही आते हैं। अब मास्टर्स के लिए विदेश जाने वाली लड़कियों का नंबर भी ज्यादा है। पहले लड़कियां अपने हस्बैंड का बिजनेस ज्वाइन करती थी, पर अब ज्यादातर खुद का बिजनेस स्टार्ट करती हैं। एंड यू नो व्हाट, पहले तो अधिकतर लड़कियां छोटा मोटा बिजनेस करती थी, लेकिन अब बड़ा बड़ा बिजनेस करती हैं। नारी शक्ति दुनिया बदल रही है और नारी शक्ति को और भी मजबूत करने उनके साथ खड़ा है SBI, 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 बैटिंग फॉर नारी शक्ति।
बिजनेस रजिस्टर हो गया? यस, सिर्फ करंट अकाउंट बाकी है। करंट अकाउंट के लिए तो SBI बेस्ट है।
हे,
हो गया एडमिशन?
यस, अब बस लोन बाकी है।
एजुकेशन लोन के लिए SBI और
करती थी, पर अब ज्यादातर खुद का बिजनेस स्टार्ट करती हैं। And you know what? पहले तो अधिकतर लड़कियां छोटा मोटा बिजनेस करती थी, लेकिन अब बड़ा बड़ा बिजनेस करती हैं। नारी शक्ति दुनिया बदल रही है और नारी शक्ति को और भी मजबूत करने उनके साथ खड़ा है SBI, बैटिंग फॉर नारी शक्ति।
बिजनेस रजिस्टर हो गया? यस, सिर्फ करंट अकाउंट बाकी है। करंट अकाउंट के लिए तो SBI बेस्ट है। हो गया एडमिशन?
यस, अब बस लोन बाकी है।
एजुकेशन लोन के लिए SBI रिलायबल है। और NRI?
अरे उससे याद आया, एक NRI अकाउंट खोलना है।
गो फॉर SBI NRI अकाउंट।
इजी है।
और सप्लाई में ऑर्डर शिप कर दिया?
हाँ, बस अब पेमेंट करना है।
पेमेंट के लिए SBI योनो बिजनेस
इंस्टेंट